Hello, my name is Professor David Karn, lecturer of accounting at the Bold School of Business at Mount St. Mary's University. And the purpose of this PowerPoint video is to discuss current liabilities and payroll. Now, we've probably seen in the past, obviously, liabilities. We know that liabilities are something that we owe, and we can break them down into two categories, current and long-term. This particular topic, really PowerPoint covers specifically current liabilities, and obviously we know that they are debts owed to creditors and that they have three main characteristics. First, they occur as a result of a past transaction or event. They create a present obligation for future payments of cash or services, and they are an unavoidable obligation. Now remember, we must specify between current and long-term liabilities. And the reason that is because they are due, current liabilities are due within 1 year or within one operating cycle. So those obligations must be taken care of. And the thing that we have to be really cognizant of is we have to have the amount of cash on hand to be able to pay those debts as they come due. Now, on the opposite end of the spectrum, long-term liabilities do not need to be paid within 1 year or one operating cycle. They are out further than that. Now, the one thing that I will say here is, let's say that you have a mortgage on a building that you're using for business purposes. Whatever is due within 1 year or one operating cycle on the mortgage would be classified as a current liability, and anything past that 1 year, the years out, the amount that's due in later years would be considered long-term. So just kind of keep that in mind. Here are some examples of both current and long-term liabilities. We've probably seen these in the past. Current liabilities would include things like accounts payable, sales tax payable, unearned revenue. The list could go on and on. You could have advertising payable. You could have rent payable. You could have salaries payable, all kinds of things that could fit under a current liability. Your more typical long-term liabilities are more limited. A good example, like we just said, was a mortgage payable. Notes payable or can be typically longer than 1 year or one operating cycle, but they don't have to be. They could still be current. And then typically bonds payable would also be a good example, and we'll talk more about bonds in another video as you move through the course. So let's talk about really how to classify liabilities from Rios Raff Company, and we have letters A through F, and we have to determine whether each liability would be considered a current or a long-term liability. So we know accounts payable, that would be current. Notes payable, due in 3 years. Well, over 3 years is the key. Long-term. Salaries payable, obviously current. Notes payable 6 months, that's less than a year, so that would be current. Sales tax payable, current. Unearned revenue due in 8 months, current. So of all of these different examples here, only one of them is long-term, and really whatever was due of the note payable within the next year or operating cycle would be considered current, and the remaining 2 years would be considered long-term. Now we talk about sales tax payable. Obviously sales tax is something that the consumer pays, and we as a business collect it on their behalf. Obviously it's not an expense of the business, but it's something that we owe. So we collect the sales tax and then we pay it to the state at different intervals. Okay, let's take a look at this problem here. It says on July 5th, Feather Company recorded sales of merchandise inventory on account, $20,000. The sales were subject to sales tax of 9%. On August 15th, Feather Company paid $1,200 of sales tax to the state. And we had to do 2 journal entries. Journalize the transaction to record the sale on July 5th and ignore cost of goods sold. and then also journalize a transaction to record the payment of sales tax to the state. Okay, so on the first one, we'll do 7/5 here, July 5th. We have to record the sale of merchandise inventory on account. Okay, so in this particular case, we're going to debit accounts receivable. Now, notice in this particular case, we have to figure out what the amount of accounts receivable is. Again, on accounts, what told us that it's going to be accounts receivable. Now, let's take a look here. We have $20,000 of sales. Let me multiply that by really 9%. So that comes out to be $1,800. So really, we have the $20,000 of sales revenue. We're going to add the $1,800 of sales tax that we're going to collect. And the total amount that we are owed would be $21,800. So that's the amount that we will debit accounts receivable for. And I'm going to write this out clear enough so we know what this specifically is, accounts receivable. And again, we will abbreviate that AR at times. All right, now, what are we going to credit? Well, we know we sold $20,000 of goods, so we will credit our primary revenue account, which is sales revenue. And that's the amount for the $20,000. And then we will also credit sales tax payable because we owe the $1,800 to the state or federal government. Usually it's obviously the state sales tax that we're speaking about here. Okay, so now on the second journal entry, which would be on 8/15, finally got my pen to cooperate there. Okay, so we know we paid $1,200 of sales tax to the state, so we will just debit and reduce the amount of our liability, sales tax payable, $1,200, and we're going to credit and give them cash. Now notice that they specifically told us they paid $1,200. They did not pay all $1,800 because all the $1,800 must not have been due at that particular interval. Then we kind of go into unearned revenue here. Remember, unearned revenue is a liability resulting from a customer that has prepaid for goods or services in advance, and that's the key. So we've gotten cash into our business, and we have not yet provided the services or the goods that the customer has paid for. Let me give you an example. Let's say that I am a photographer, and I have a photography business. I require that customers, when they book a photo shoot, would pay a $250 service deposit in advance so that they could book their session. So at that time, when they paid that, I would debit cash because cash was coming in, $250, and I would credit unearned revenue because now I owed them $250 of services in the form of photography. So once they came and they received their services, I would be able to get that out of unearned revenue and into regular service revenue, and then hopefully also book the additional amount that they paid for the services that I provided to them. So let's go through the examples I got here. You can see both goods and services. Example 1, a customer prepays $10 to reserve a copy of a video game, and that would be where you'd be prepaying for goods in advance. So if you went to GameStop or some type of video play game that sold video games and you could pre-order a video game, basically that money that you give to them to put in that deposit for that game is unearned revenue to them. They have not yet provided you the actual good yet. And obviously you have to pay the balance that you owe when the game comes in and you pick it up. The second example would be where a customer prepays $500 for lawn mowing services to be provided next summer. So let's say that the person asks you to pay give you for the 3 months, instead of being $600 or $200 a month, you can prepay and get $100 off. So if you do that, now you're prepaid up all the way through the summer for lawn mowing services, and then as the lawnmower comes and cuts your grass, he or she will be able to record the revenue as now earned once they provided those services. Now, in either case, if for some reason you do not receive the services or goods at the appropriate time, obviously you are entitled to a refund unless it specifically unless it specifically states that you are putting down a non-refundable deposit. And if you don't get those services that you've prepaid in advance and they're holding your money and they're not giving it back to you, then obviously you could seek legal means to recover that. Okay, on June 1st, Guitar Magazine collected cash of $51,000 on future annual subscriptions starting July 1st. And we need to do 2 journal entries. One, to journalize a transaction to record the collection of the cash on June 1st. And second, to journalize a transaction required at December 31st, the magazine's year end, assuming no revenue earned has been recorded. Okay. And then we're around the adjustment to the nearest whole dollar. Okay, so the first journal entry on June 1st shouldn't be overly difficult. So let's see how that plays out here. On 6/1, we're going to debit cash because we have cash coming in of $51,000. And then obviously we were paid in advance. We've given no subscriptions out yet. So this is all booked as unearned revenue, and that's what we will credit for $51,000. So that takes care of journal entry number 1. And the second journal entry now is we have to take the $51,000 and determine how much of that we have earned during this past year. Okay, so if you look at this, basically the annual subscriptions start on July 1st. So basically we have to look from July 1st really all the way through the end of December. So that really is half a year or 6 months. So I will take $51,000 times 6 out of 12 months, and that comes out to be $25,500 that we would have earned. All right, very easy transaction here to get this taken care of. Now, all we've got to do is get it out of unearned revenue by debiting that. $25,500, and I will credit service revenue. In this case, it would make sense to I would use a subscription revenue as the account to go there. Now, if you would have put service revenue, I guess that would be fine. Sales revenue, fine as well. But I would focus in specifically, since it is a subscription, you would use the account subscription revenue. Okay, so then we shift gears and we look at short-term notes payable. Remember, if we have notes payable due within 1 year or one operating cycle, that would be considered a short-term notes payable. And we will really have to deal with any interest expense, and if it doesn't come due until the accounting period ends, what adjusting entry do we have to do? So we have some issues to address. Remember, our formula that we'll use in this particular case will be I equals PRT, and I equals PRT stands for interest equals principal times rate times time. And for these problems, you want to make sure that you use 360-day years. So let's take a look at a problem here and see how we do. It says on December 31st, 2015, Franklin purchased $7,000 of merchandise inventory on a 1-year 11% note payable. Franklin uses a perpetual inventory system, and we need to journalize the company's purchase of the merchandise inventory on December 31st. As the first requirement. Okay, so 2015, and we're going to record the 12/31 transaction. Okay, so we know that merchandise inventory is coming in, so we're going to have to debit that. And that would be for the $7,000. And we wouldn't credit cash because we used a note payable, so we will credit that. So notes payable. So that takes care of that. And again, there's nothing to deal with as far as any interest in the beginning when we record the transaction because we have not incurred any at this present time. Okay, so we know we've done this first requirement. Let's go to the second requirement, and that is to journalize the company's accrual of interest expense on June 30th of 2016, its fiscal year end. Okay, so now what we have to remember is that this is an adjusting entry because the company's fiscal year is ending, and even though the note is not yet due, we certainly have incurred, and we now have to recognize the interest expense within this accounting period that is currently ending. So let's do our formula. I equals PRT. We know that the principal is $7,000. We know the rate is 11%. And we know that basically we have 6 months have elapsed, really January 1st all the way through June 30th. So we can do 6 months out of 12. We could do really 180 out of 360. It really makes no difference. It all comes out to be the same answer. So we know that our amount, the adjusting entry of interest expense that we've incurred is $385. So on June 30th of 2016, I'm going to debit interest expense because I have to recognize that in this period. And remember, in this case, we're not paying it because the note is not yet due until the end of the year, 6 more months later. So we owe it, so it would be a credit to another liability, which would be interest payable. So I recognize my expense. By following, that'll go on my income statement and reduce my net income. And then my interest payable will increase my current liabilities and go on the balance sheet. Okay, so we've done 1 and 2. Let's look at the final piece to this particular problem. It says journalize the company's payment of the note plus interest. Okay, so here's where it gets a little bit tricky. We've got to make sure that we account for everything. So let's do the easy thing first. We know we're going to debit and remove from the books the notes payable because we're paying it in full, and that was for $7,000. And is this not cooperating? Oops. We know that we don't, after we pay this, we no longer owe the $385 of interest payable because we're going to pay that off. The note is being paid off. So the interest payable is being taken care of. Now remember, we've only had the interest calculated for up until the current year, June 30th of 16. So now we have another 6 months, really from July 1 through 12/31 of 16 to account for. So that's another 6 months, so it's going to be another $385 of interest expense that I have to recognize. And we will credit cash for the full amount of $77.70, where I added up all the debit amounts. Now you could also prove this. You could take really basically a very simple transaction here, I equals PRT, and we could find the amount of cash that we would have to pay. I equals 7,000 times the rate of 11%, really times 1 because it's for 1 year, or 12 out of 12 if you want to do it that way, and you get $700. So then we would take the $7,000 plus the 700, so we can see that the maturity value of this would be the principal plus the interest. That is my maturity value, and that is the amount that we paid down there. Okay, one final slide on this particular section, and really one small problem to do. So it says here that again, we have to make sure that we properly appropriate the current liability portion of a long-term notes payable. So make sure that we pay attention to those particular circumstances, like I told you earlier about a mortgage. Whatever would be due within the current year or one operating cycle would be considered current, and the remainder would be considered long-term. So they just did a very small problem here. It says on January 1st, Garland Company purchased equipment of $120,000 with a long-term note payable. The debt is payable in annual installments of $24,000 due on December 31st of each year. At the date of purchase, how will Garland report the note payable? Okay, so this is really on 1/1. We're going to purchase equipment with a notes payable totaling $120,000. So the way we would look at this, current liabilities, let's take a look and see how this would work. So we know that the first installment is due on December 31st of the current year. So that would be notes payable we would have to deal with would be $24,000 for this current year, and we would classify the remainder as long-term. So we would take $120,000 minus the current portion of $24,000. So long-term would be considered to be classified as $96,000. So you can see how that's broken down. The reason, again, we do this, as I stated earlier, just to reinforce, is we need to make sure that we have our cash available on hand to meet these obligations. While it may seem, unimportant, if we get to the end of the year and we don't have the $24,000 installment payment available to us in cash, then we have to, really address that issue, and that could be problematic if we do not pay that amount when it is due. All right, let's end here for this section, and then we'll continue on by looking at payroll.